and welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Dave Nadig of ETFs.com. Kevin O'Leary of O-Shares with us as well. Markets in turmoil today on trade war fears, with the Dow plunging more than 750 points at its lows. The S&P on pace for its worst day this year. But gold having a great day. The yellow metal now at its highest levels in 6 years off of these trade tensions. And that's got gold ETFs gleaming, the GDX in particular. Gold stocks rallying to their highest level in almost 3 years. How do you get on the gold rush here? Dave Nadig, we have done this many times, you and I, with gold. Remember, gold was a hedge against inflation a few years ago. That went away. Now it's a hedge against uncertainty. I noticed creations of the gold ETFs, the GLD, for example, very high. That means people are actually coming in and actually buying gold, and they're having to put more gold into these gold ETFs.
Yeah, by the amount of gold in the vault, ETFs are at about 8% below all-time highs in terms of the amount they own, which was back in 2012. And we've got all sorts of new buying coming into the market to support this too. We've got central bank buying up 57%. We have all the short interest in the gold ETFs pretty much getting flushed out in July. So really all we've got is demand from folks who are looking for safe haven assets on days like today.
Kevin, you like the GLD, but you also own some physical gold as well. I mean, you actually own physical gold yourself.
I do.
And what's the rationale for that?
A lot of people don't understand that holding the commodity itself has a lot of friction in terms of cost. The GLD itself, for example, is 40 basis points, but it's the most high volume liquid of all of them. So if you're managing a large amount of money and you say, I keep 5% weighting in gold, I know I'm always going to have 2.5%, so I bought the physical gold, I pay for the storage, which is way cheaper than paying the 40 bips on the trading vehicle I'm using to keep myself at 5. Today, for example, I have to sell down to 5. Gold's gone up a lot. I'm way overweighted, and I'm selling into the strength to get myself back to 5. I can't do the physical blocks. I can't move them out on a trailer. I'm using GLD, but it ain't cheap. It's 40 bips.
Yeah, but you have brought it out many times. There is an alternative,
yes.
BAR.
The
same thing. It's a vault of gold in it. We have no reason to think anything's different going on there. They're what, 17 basis points?
17 basis points.
One's 40.
Granite Shares Gold Trust.
Right.
Really exactly the same exposure. If you need the liquidity, if you're moving millions of dollars around in 20 minutes, you need GLD like Kevin's talking about. If you're planning on holding this position for years, you might as well save yourself those 20, 30 basis points.
Explain the difference between holding gold and gold stocks here. We know, of course, in theory, they're related, but gold stocks can also be influenced by the overall movement in the stock market.
Absolutely. It's really
Is there a reason to own gold versus gold stocks right now?
Yeah, absolutely. Do you want to be owning the companies that are effectively digging this stuff out of the ground with all of the single stock risk, management risk, potential for labor problems, et cetera, or do you just want to own the metal? Pros and cons to both. Gold miners in general have been hit real hard in the last couple of years. They've had a bit of a comeback. Gold is gold. It just is what it is.
You don't care about gold stocks, do you?
I never touch gold stocks because you're letting a layer of idiot management between you and the price of the commodity. The history of managers of gold companies is abysmal.
It's not
I'm
good.
just telling the truth.
It's not
good.
It
is abysmal. They cannot control cost of extraction. Why touch that? It's full of volatility and bad management. And please, don't give me the hate mail. I've been saying this for 20 years. They really suck at managing extraction.
Well, what is gold these days? I meant that as a bit of a joke, but I'm quite serious. Years ago, it's going to be a hedge against inflation. That didn't happen, and now it's going up as a hedge against uncertainty. What is it? Is it a hedge against Bitcoin? What is it a hedge against?
If you're a global investor and your opportunity is either buy gold in some form or go buy the Bund at a negative yield, gold looks a whole lot more interesting, honestly.
Sure.
So I think gold's status as a safe haven asset has only gotten stronger in a declining rate environment.
All right, let's get to the flow down, talk about where the markets are going here. ETF market attracting $21 billion of investments in July. U.S. equities seeing the bulk of the inflows. That brings the total inflows in the ETF market this year over $150 billion, almost half of the inflows coming from fixed income. Take a look at some of the year's biggest winners there. You see inflows. Spider finally getting some inflows. And we're seeing the iShares Russell 2000, some inflows. I guess the question here is, yes, equity ETFs still seeing inflows, but these bond funds, just money oceans of money.
And the reason you don't see any individual bond fund there is because it's across the board. It's everything from the 20 to the 3-month to mortgage backs to junk bonds to municipal bonds. The entire U.S. bond sector has just been an umbrella turned upside down, catching money from investors.
Can you make any case for owning any kind of bonds, including high yield?
I have a really hard time taking duration risk at 1.8% on the 10-year. It doesn't make intuitive sense when I can get 2.4, 2.5% yield on the currency of equity. In other words, think about this. The companies themselves that are issuing credits are paying less in yield than the dividend that you get owning the stock. Why in the world would you buy a credit with duration and quality risk when you can own the underlying security that's actually giving you a piece of the cash flow? We're in strange times here.
Yeah.
And I am not sticking my capital into a 10-year duration at under 2%. You know, you can lose a lot of money when the market decides that, you know what, I don't think a 10-year should be at 1.7, 1.8%. I think it should be at 2.5. You're going to lose 25% of your capital.
But why aren't we getting any inflation? In theory, with the Fed cutting rates, and now we've got a whole bunch of tariffs around the world, wouldn't that be inflation? If we don't get inflation of some kind here, it's a little strange, isn't it?
Yeah, well, I think maybe we will get it. It's always the vigilantes that say it doesn't matter till it matters. And then in a 48-hour period, grown men are weeping that have huge duration on their fixed income.
I've been waiting. We've been told the stories for 5 years now. We've been talking
You're
about.
right.
I just want to move on because I want to bring on our guest and get his thoughts about what's going on here. The biggest trading venue for ETFs. You know, it's right here under our roof. It's the NYSE and NYSE ARCA. Doug Yones is the man in charge of the NYFC's ETF business. He joins us now, and you watch this stuff like a hawk. Chime in on this. We're continuing to see astonishing inflows into bond ETFs in general, still inflows into equity ETFs, but not as big at this point. Do you see this continuing into the second half of the year?
It's been a great year at the start, and we're talking about some of those numbers, almost record numbers, but the fixed income story is just in the earliest of early stages. As Dave was saying, right, it's across the board. We've got over $83 billion coming into these funds, and it's not at a loss somewhere else. It's not as if we're seeing equity funds sell off and money flow into fixed income. Instead, you're just seeing adopters of the ETF strategy, the ETF wrapper. They want the liquidity, they want the ease of use, they want the diversification, and instead of choosing a mutual fund, they're coming to the exchanges and they're buying the ETF.
So we've got what now, $4 trillion essentially in ETFs?
Roughly $4 trillion now, that's right.
We still got 2,000 ETFs out there. I'm not going to ask the man in charge of ETFs whether we have too many ETFs. The fact is they're opening and closing a lot of them.
You'll know the answer. You'll know the answer from me, right? Which is there's still a lot of opportunity out there, and we are seeing it, right? We're seeing people come to the industry and say, is there a new way to slice this up? And I look at something like real estate. Historically, it was just a broad-based REIT strategy, let's say. Now, all of a sudden, you have issuers coming in saying, well, what if I just look at the places that host data, server farms, right? And now you have an ETF that focuses on cloud storage. So there are really unique ways to slice and dice the market, and it's happening in the world of ETFs.
And I love watching ESG kind of grow up, environmental, social, and governance. We all used to roll our eyes about this, saying, heavens, come on. I mean, everyone talks about it. We're all supposed to be environmentally, social, governance responsible, and yet where's the money?
Performance issues.
Well, that's right. Where is the money? Because the performance hasn't necessarily been there, and yet we've talked about this, Doug. The interest is growing.
The interest is growing, and the money's finally following, right? It used to be, well, let's all talk the nice talk, but let's not actually invest there, and that story's changed a lot. The two biggest launches in probably the last 10 years have been in the ESG space this year. And so the money's starting to finally flow in, the growth is there, the numbers are there, and it may have been a change in investor dynamic, or it may have been that the products themselves just weren't the right products, and now we're building the right things.
But Kevin, I understand your cynicism about this. I feel the same way. If everyone loves this so much, where is the interest or where's the money flows and where's the outperformance?
I think the biggest
we haven't seen it although Doug mentions there is interest starting to grow.
Yeah, there is. But imagine if you're a fiduciary for a teacher in a pension plan and you keep them out of munitions and tobacco, and you're trailing the long-term index by 250 basis points because you're not in these sectors. Tobacco produces a lot of dividends and return of capital to people. And my attitude is, if you're stupid enough to smoke, shouldn't I profit from you? Yes. I wouldn't smoke. You'd have to be an idiot to do that.
Yeah,
but if you're taking away performance from me because you as a manager have a personal feeling about tobacco, I bet you end up in litigation one day. That's what I think. So this whole issue about performance and what is a feel-good stock, what about sugar? What about sodium? What about food and all the stuff around meat, non-meat? Where does all this fit into an index that you can actually understand what you own at any one time?
Well, you've had to face this. Is a pension fund really in trouble for ignoring or excluding companies that wouldn't fit into a proper ESG screen?
Well, I think some of that conversation in some ways is the old conversation. What I mean by that is the new ETFs that are coming to market, they're actually going in and they're sector neutralizing. They're going in and they're saying, hey, here's a sector of exposure. I'm not going to hold those companies for various reasons, personal reasons or just larger persona reasons, but I can neutralize the sector exposure and actually bring back some of those returns.
I want to just another quick subject. We've been waiting for a little more news about trading ETFs here on the floor of the New York Stock Exchange. We don't have it yet, but we're moving in that direction. Can you give us an update?
It's exciting times. For those of us that have watched this industry for a long time, it's a bit of coming home. The original ETFs, they were actually listed on a floor, but at the American Stock Exchange. And the New York Stock Exchange is now preparing. We're hoping to start to roll out this program within the next couple of months, where we'll actually bring ETFs back down to the floor, where you have the designated market maker that can add the human component to trading ETFs.
Will there be more liquidity? Will it be even tighter spreads? What do you think will be accomplished by doing this?
We're going to bring the power of the floor, the magnitude of that designated market maker, the person that's responsible to be there to add liquidity, but also reduce volatility. We've offered this to the greatest companies in the world for over 227 years. It's time to offer that back to the ETF industry.
10 seconds, I need a quick answer. There's a move towards non-transparent ETFs. We had Pisani active shares down here. Where is your thoughts on this? Where does the NYSE fit in with that?
It's a watershed moment for the whole ETF industry. There's something like $17 trillion in actively managed funds that have not been able to access the ETF market unless the star manager is willing to show everything in the portfolio. This will give them a chance to enter.
You think that'll expand the ETF pie considerably?
Dramatically.
Okay, we'll keep an eye on that and let us know about trading on the floor. Love hearing about that. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave Nadig, Kevin O'Leary, and Doug Yones for joining us today. And thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.